Let's take our conversation forward with Ravi Dharamshi to understand what he is doing in this market. How is he shopping? Is he protecting capital, or it's time to just stay away? Sometimes staying away is also a good strategy. Ravi, we can get into why we are here, but what matters is what should be a best strategy. Is it time to buy the fall, or is it time to just let the market adjust and come back when there is clarity?
Good morning, Nikunj, and good morning to your viewers. We have chosen quite an eventful day to come, right? So let me give you, a quote from the book Reminiscences of a Stock Operator. There is nothing new on Wall Street or Dalal Street. It never will be. The speculation is as old as the hill. Whatever has happened in the market has happened in the past, and it will happen in the future again. So only the variables and how we react to it, all those things change by a minor thing. But war is not new. Market correction is not new. Crude spike is also not new. We find our reasons to correct. I think a 15-20% kind of a correction on the indices would pretty much have been par for the course had you asked me about 4-5 months back. Of course, I have not taken any kind of an action to move into cash, because that's not what we do. We focus on the 3 to 5 year horizon, and markets can't keep going one way up. So we have corrected. We started off the correction with the scare of interest rates rising, but now it has quickly manifested itself into scare of inflation due to commodity prices and crude prices going up, which got accentuated by the war that is panning out. So we are where we are, and there is a good reason for where we are.
Will we stay where we are for a long period of time? What do you think will be the turning point of the market? Because markets, they bottom out if the situation changes, or prices, they reach at a level that markets, they've discounted everything. What is your view on both? What will be the turning point for this market?
No, you are absolutely right. I don't think one should now be betting on the fact that commodity prices will keep rising. The big money over the medium term now will be made by people, those who anticipate what's going to happen in the future. And the billion-dollar question is, how long will this war prolong? How long will these kind of conditions last? And I am not an expert on macro. I'm not an expert on geopolitics or anything. And I like to believe that I am a follower of macro trends rather than trying to predict where it is going to be. So in my limited considered opinion, I don't think the conditions are going to last too long, because finally this is a war between two unequal sides, and for most of the developed world has kind of made it stand very clear they are not going to join the fight. They are going to only provide with arms and sanctions to fight this. So, and even Russia has made it quite clear that their aim is not to occupy Ukraine, but it is to demilitarize. So I feel this cannot prolong too much. And there is a confluence of many other events also pretty soon. The state elections, the fuel price hike, the Fed rate hike, everything is bunched up during this week. So I get a feeling that we are pretty much at the crescendo of this particular move, crescendo on the reverse side, that is. So, and it's a blowout move on the commodities side, and the risk assets are falling off. So I can't pinpoint, nobody can ever pinpoint, but I feel we are closer to the correction completing itself over a period in the next month or so, rather than, one has to be not worried about capital erosion from this point of time. So of course you have to take care that you are long-term investors, you do not have leverage, and your stock picking is good. So this can call for a good reason to churn the portfolio. Make sure you pick the weed out of your portfolio, and make sure you hold on to your winners, and for the right reasons. So I don't think this is going to result in a big change in our portfolio strategy, and I am not betting on this prolonging for a long period of time as well.
Ravi, let's look at the flip side. Now I'm completely with you when you say that it's not for the first time we've seen a correction like this. We've seen scarier days, 9/11, 2008. COVID fall in March and May, when absolutely the bottom was knocked off from the floor. So if I compare the March 2020 fall versus this ugly patch of volatility, I think this is nowhere close to what we saw. I mean, that fall got the fear of God in everybody. It's nowhere close to that. But a lot will change in terms of your assumptions of earnings, the impact of energy cost, the demand scenario, the margin picture. How much of that scenario of high energy prices or adjustment on margin is something markets have factored in?
No, I think you are absolutely right on both the counts that market needs to adjust to the rising material cost as well as the rising inflationary kind of a scenario. Of course, there was some murmurs even before the war started that the margins were getting hit and interest rates were on the rise. So to some extent, market had started adjusting, but I think the full impact of this will be panning out in the first quarter of FY23 from margin point of view. However, just to give you some sense on, it's not all gloom and doom. There are a lot of positive as well. So usually in this kind of a scenario, our currency tends to be the first casualty. And surprisingly, that is very, very well managed by RBI, thanks to the huge forex reserves that we have. So that remains very much a positive scenario. Second, I feel even though post the state election, there is going to be a fuel price hike, but I think it will be combined with a tax cut as well to reduce the impact on the consumers as well as the businesses. The third big impact that since April of last year, we have seen almost close to 2 lakh crore kind of an outflow and now outflow from the secondary market. And that is it's now reaching $1 billion a day kind of situation. So given all this, but the fact that FDI has been a far more stable source of money coming in has ensured that the rupee volatility is not too high, and the ability of the domestic flows to absorb the FII selling has also increased. So otherwise, this is unprecedented selling that we have seen. And I think there is a lot of silver lining. It is not all gloom and doom. And I think long-term investors with a more than a year or two's outlook will do well to start accumulating over here.
You're talking about silver lining. Why don't you talk about that silver lining? Why should a long-term investor not panic? Why do you think that this is a time to accumulate? Why do you think it's too late to sell? Why do you think it's time to buy the fear?
No, I don't say it is too late or too early to sell or anything. This is not the time to be taking a cash call, is what I'm saying. One can obviously sell out of companies which they believe should not feature in their portfolio. So some amount of churn is justified. Coming to the silver lining that you mentioned, the kind of hiring that is happening across sectors. So what started out with the IT and startup world has spread across sectors. And the kind of wage increases most of them are getting, that is having second order derivative effects on the real estate demand, on the rental demand, on the even the opening up trade, not an opening up trade, but the opening up of the economy is acting as a stimulus. There is so much demand for eating out, traveling, and all those things are yet to fully get factored in. There is a lot of latent demand in every sector. The order books are full. Most of the companies are still have capacities to cater to this rising demand. So operating leverage is still ahead of us. The balance sheets are pretty much in under control in terms of leverage. Credit growth is just about picking up. So the stage of the economic cycle that we are in when this crisis has come tells me that the cycle is not going to turn on a dime. We are going to witness further strengthening of the growth cycle. And this is pretty much a par for the course kind of a correction, whatever the reason could have been. I mean, I had no idea that there was going to be a war, but if you had, as I was saying, that 4-5 months back, there was the case could have been made that we are going to correct 15-20% on the index. And I think that's panning out. It's just that the reasons have emerged much later. And yes, the specificity of the reason is that it is leading to crude spike. But I think now almost $100 plus kind of an average for the year is getting priced into the in all kinds of numbers. So if we do not sustain at $100 plus, I'm talking on an annual basis, then I think there will be some positive surprises also later on in the year.
Good morning. This is Nantara. You had already started tweaking your portfolio about 6 months back towards cyclicals, finding more value there. The question I want to ask on behalf of our viewers is this also not the time, if they choose to trade at all and not sit back, to add more defensives, whether it is IT, whether it is pharma also?
Good morning, Nantara. See, I don't like to label companies as whether it is defensive or sectors also as defensive or aggressive or growth or value. But at the same time, characteristics of the companies that you want to bet on is where the future has not been factored in too much and the positive triggers lie ahead. So absolutely, pharmaceuticals is one such space where I believe that we have been in a negative phase for the last 4-5 years and the positives haven't panned out. So most of the negative is captured in, and the space is very well valued, and it is one of the space that really does not get impacted by what is happening in the global market. The crude prices don't impact them, the metal prices don't impact them, and neither do the interest rates impact them so much. So from that perspective, I feel that is one space that one can look at. However, on the other side, you mentioned IT. I would say that IT was pretty much factoring in a lot of growth, lot of margin improvement, and they have some challenges in terms of retaining talent. So the margins have expanded, and I think retaining those kind of margins is going to be a challenge for IT. So I would not categorize IT in the same space, as in the same value bucket as you were. So I would say there are pockets where you can make money from medium term point of view, where you can start deploying. Even some of the growth names, I think I've pretty much given up on their most of the excess growth assumptions are out of the window. Now it is more realistic. You still have to do your stock picking. Can't go ahead and blindly buy anything.
Oh no, you can't buy blindly anything. This is not, mid of 2020 at all, Ravi. But having said that as well, and again, I'm asking this on behalf of our viewers, you're looking at the kind of numbers that FIs have been selling off, right? Topping $10.5 billion. It's more than what we saw in 2008 and the great financial crisis. However, the DIIs are what are supporting this market. Could that be a trade to look at for our viewers? Look at more stocks that are DII dominated.
No, that is precisely the reason why some of the small cap, mid cap stocks have not actually fallen that much. So there is a lot of outperformance already built into it. And at this juncture, I think there is in fact a risk that some amount of capitulation can happen on that space as well. One has to be prepared for it. I don't think one has to now go ahead and buy. In fact, I think where FIIs have sold out is where probably the value is more likely to emerge. Because I would rather bet on FII selling, abating over the next few days, weeks, months, rather than DII buying, getting stronger from this point on. So, but again, these are all technical factors. I would rather focus on the company, and if the company that you are holding or buying has strong fundamentals, it doesn't matter what the color of the money is, money will flow into it.
Ravi, I was just tracking the market screen, and the only green is on oil, it's on Brent, it's on natural gas. And besides that, it's quite intriguing that, one is seeing a jump up in cleaner fuels as well. I was looking at reformulated blend stock for oxygenated blending, and then, ULSD as well, which is a contract distillate which contains lesser amount of sulfur. As a strategy, do you now need to perhaps align your portfolio a little bit more to greener fuels, companies with less dependency on oil imports? Maybe have a higher, allocation to, for instance, ethanol plays back home?
So I strongly believe that move towards cleaner fuel, greener fuel is a mega trend. And what this event and the macro play out, geopolitics that is playing out, has only accentuated that trend further. Not only will people want to become more self-sufficient in their fuel, but they also want to de-risk themselves from further from the fossil fuels. So this does nothing else but accentuate the trend even further. Whether it is ethanol, whether it is solar, or whether it is any other kind of a renewable technology play, I think the government focus, the investor focus is only going to increase from here for the next 5-10 years. And yes, absolutely, we should be focused on those companies.
And I'm guessing that wouldn't include EVs just yet, would it?
So EV, I would like to split the EV space into two-wheeler and passenger vehicles. I think the two-wheeler disruption is very much here. That is the fastest growing space in the entire auto space. So two-wheeler disruption is already underway. Passenger vehicle disruption, I believe, is still 2-3 years away. But the winners on that space are still not very clear to me. I don't want to be early in aligning myself with somebody because I still believe that some amount of potential is there that even the incumbent OEMs can get their act together and get a play. See, finally, this is not a disruption as so much of technology as it is of a new product. So obviously, the worldwide trend is very clear, moving towards EV. And in India also, the adoption is going to happen maybe in a few years' time. So I think the first space to look at would be e-two-wheelers. Then other space to look at would be maybe e-buses and all those kind of things, rather than passenger vehicles at this juncture. But even that is a auto anchor. Some of the auto anchors that are aligned with the EV players might be a much better bet, because whichever player succeeds, the components are going to come from these players. So there are very few plays available on that front. But I think that is a better way to play the EV trend.
This shakes the market texture. This time it's a shock, more than a crisis, it's an energy shock. Will the orientation of the market change? And why I'm asking you this question just for the benefit of our viewers, Ravi, let me just establish the basis of my question. When COVID crisis happened, when market came back, deep value started coming back, pharma started coming back, IT, the business proposition changed. Reliance started raising a lot of capital. Startups, they started coming back. So because of the shock, Ravi, what changes in terms of market orientation?
Right. No, absolutely. Every crisis is an opportunity. Every shock leads to a behavior change. Having said that, I would like to say that we haven't yet reached the kind of shock that we have seen in the past. The Indian economy has also grown. The percentage of the absolute consumption of crude or fossil fuel might be on the rise still in India, but as a percentage of the GDP, as a percentage of the overall fuel basket, it is constantly going down. So, and our ability to absorb these shocks externally on the forex front and in terms of integration with the global supply chain has also improved dramatically. So I don't feel we have reached that stage where dramatic things need to happen, but we have already been on a trend without. So I think one of the credit to the government is that we had already started focusing on Atmanirbhar and self-dependence since a few years. So that is holding us in good stead at this point of time when most of the other countries are struggling, whether it is on the vaccine front, whether it is on the payment front. We have ensured that we are not dependent on so much on foreign companies. Of course, we are still dependent a lot on foreign capital, but even that dependence seems to be reducing going forward. So I think we are in a much better position, and it is not yet a shock to the economy. I hope it doesn't become one, but it is not yet one.
Put up with one thought on private banks. There was nothing wrong with the Q2 numbers. Q3 guidance was not bad at all. And Q4 is when all the banks have got clobbered. 5-10% fall is now normal for some of these private banks. Is there fear in the market? Is there dislocation in the market where you want to be a buyer in HDFC Bank or an ICICI Bank or both perhaps?
No, I believe it is purely driven by the fact that it is an over-owned sector by FIIs. The amount of over-ownership on the FII front has been coming down on the bank side. So I believe that this is a good opportunity because the bank's fundamentals are going to improve, are improving and will improve. whether it is private or even for that matter, even public sector owned banks, are the fundamentals are very strong. So I am not overly worried about this correction. I think it is an opportunity. I think it's a matter of what do the FIIs own and where the liquidity is, and they are selling out of whatever they can sell, regardless of how the fundamentals are going to pan out over the next couple of years. I think banks are going to have a good time. There is going to be credit growth. There is going to be, and especially a little bit of corporate orientation or cyclical revival in the economy. It's a good proxy to play that. But of course, the macro worries at this point regarding the interest rates are weighing more on them rather than the medium-term fundamentals.
Well, Ravi, appreciate your time. Thank you for joining us.